Hello, welcome back to the Intelligent Investor series. Chapter 3, A Century of Stock Market History. In the third chapter of The Intelligent Investor, Benjamin Graham wants to get investors thinking about the big picture with a macro view of the stock market over the previous 100 years. Fortunately, useful records did go back to 1871, so he was able to gain that perspective when he wrote his final revision in 1973. This chapter is almost completely historical. Graham compares stock prices, earnings, and dividends for the preceding 100 years using 10 years average. The investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history in terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and the earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times. By a coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years to 1871. In this chapter, figures is presented in highly condensed form with two objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages not only of stock prices but of earnings and dividends as well, to bring out the varying relationship between the three important factors. Graham outlines the various predictions as to expected future stock market prices which he and his colleagues had made at particular points in their careers. The overarching conclusion of this history is that prices are difficult if not impossible to predict. Graham, for instance, had about a 50% success rate in his prediction, which is precisely that expected by chance. In other words, there is no reason to assume that his predictions taken as a whole were correct by any rigorous definition of the term. The principles of investment as set forth herein would call for the following policy under 1964 conditions in order of insurgency. Number 1, no borrowing to buy or hold securities. Number 2, no increase in the proportion of funds held in common stocks. Number 3, a reduction in common stock holdings where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible and the proceeds invested in first quality bonds or held as a savings deposit. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. The rest of the words to be continued. How did you like the video? Please comment. Don't forget to like, share and subscribe to WeCan channel. You can buy the Intelligent Investor book from description. How did you like the video? Please comment. Don't forget to share the video. Please subscribe WeCan channel.